Hello, it's Craig Larson with Larson Financial Advisors for our Market Minute on December 3rd, 2013. Holiday season is upon us. I know that you're probably anxious to go out and eat some cookies and do some shopping, so I'm going to make this as fast as I can, but I have a lot to say, so bear with me. The market continues to, and this U.S. stock market, by the way, continues to set all-time record highs. It's been doing that repeatedly over the last few months. So the question comes up, is that a good thing or a bad thing? Historically speaking, all-time record highs or 52-week highs even are a good thing typically for markets. It indicates strength. So this trend we've had in stocks has been, really strong, really persistent. It's been great, okay? However, do not get complacent about that. I'm sensing a lot of investor complacency out there, and I want to tell you, this is not the time to be complacent because a couple of very important data points and risk factors have come across my desk in the last couple of weeks. Number one is valuations. And valuations, or PE ratios, can be very misleading in stocks because there's many ways to calculate them. The methodology, in my view, that appears to be pretty reliable is Robert Shiller's methodology. He's a professor out of Yale. You've probably heard his name in reference to the stock market or to housing market valuations. And his measurements for valuations indicate that we're at a fairly high level. Not an extreme like we saw in the year 2000 before the tech bubble burst, but high levels which have accompanied market downturns in the past. Most notably, peaks in 2007, peaks in 2000, 1987, 1972, 1929. Now, I'm not going to delve into all those, but take those years, go back and do some historical research, and see what happened in markets over the 1, 2, or 3 years after those points, and it will wake you up fast. Secondly, next data point, margin debt on the stock market. Margin debt, for those of you that aren't familiar with the term, is when you open up a brokerage account and you borrow. You take a loan from the brokerage house so that you can invest more money into stocks. And when do people typically feel most confident to borrow the most? You got it, after the markets already went up a bunch. And so margin debt, historically, often will peak around the time that there's a major stock market peak. So just so you know, just a few weeks ago, we hit an all-time record high on margin debt. And it was about, it was over 2.5% of GDP. It was $412 billion in margin debt. And that level, compared to the economy, has only been reached several times in history. Again, similar time points, 2007, 2000, 1987, 1972. So these are contrary indicators. They tend to hit extreme points near market tops. So does that mean we have to hit a peak and have a big collapse coming up? No, it doesn't mean that at all. But we look at the historical precedents and we say, very often history repeats itself, or it kind of echoes a little bit. So we have a couple of very hostile data points that have accompanied a very positive trend here. So don't be complacent. Make sure you have a risk management strategy. If you're a current client of ours here at Larson Advisors, we've already discussed this with you. If you'd like a refresher or want to relook at it, please call. If you're not a client of ours, you really need a plan, and we would like to help you with that, and we can discuss some different risk management methodologies with you. So feel free to call or email me at the information below the video. I'll come back and give you an update on this in the next few weeks. In the meantime, thank you for tuning in and have a great Christmas season.